Morning. Welcome all to this very important hearing. The purpose of today's hearing is to highlight the true costs and risk posed by the government's ongoing bailout of Fannie Mae and Freddie Mac. It also seeks to shed some light on the hidden costs of the mortgage insurance program run by the Federal Housing Administration. This is obviously a very complex subject, but a critically important issue. The federal takeover of Fannie and Freddie is the most costly taxpayer bailout in the wake of the 2008 financial crisis. For years, we were told Fannie and Freddie pose no liability to the federal government. Through their unique status cultivated through political influence, they pursued what I would call crony capitalism, and the taxpayer is now being stuck with the bill. To date, the Treasury Department has provided about $160 billion to Fannie and Freddie, and the CBO estimates that their all-in cost for the decade will be about $370 billion. While the Treasury Department has put forward a framework for reform, the Obama administration still does not account for these estimated future costs in its budget, even though it has lifted the cap on Fannie and Freddie's line of credit. When it comes to this ongoing bailout of Fannie and Freddie, taxpayers have a right to know how much they are on the hook for. FHA is different than these two GSEs because it is included in federal budget totals. However, the current budgetary treatment of FHA understates the risk and costs of FHA guarantees, which now amount to nearly a fifth of all new single-family home loans. While CBO adjusts the costs of Fannie and Freddie loans for market risk under the Federal Credit Reform Act, budget projections do not incorporate market risk into the cost of FHA guarantees. The housing market is still in a very fragile shape. All the recent news confirms this. There are no two ways about it. For the homeowners, for taxpayers, and for working families across this country, we need to put an end to an ongoing bailout of Fannie and Freddie and advance serious permanent solutions. That starts with a full accounting of their activities. We must advance plans to reform Fannie and Freddie, to fully account for FHA loans, and to stop the hemorrhage of taxpayer dollars, and to limit the government's dominance and distortion of housing finance. I look forward to hearing from our witnesses today regarding these serious problems, and I look forward to a constructive debate on how we can save taxpayers from the consequences of misguided housing policy and crony capitalism now and in the future. We have our own experts from our side of the aisle, Mr. Garrett, Mr. Campbell, who are senior members of the Banking and Financial Services Committee. But before I turn it over to the witnesses, I'd like to recognize Mr. Van Hollen for his opening statement.
Well, thank you, Mr. Chairman. Let me also join you in welcoming our witnesses today. As the Chairman said, this hearing focuses on a number of issues, including the technical issue of how to best account for the costs of federal support for the housing markets, both now and possibly into the future. That's a very important question. Whatever method we use should accurately and transparently provide the best estimate of what those costs are to the taxpayer. But the larger question, and the one that will have a much bigger impact on taxpayers and the economy, is how our housing policies, what housing policies decisions we make going forward, and how they will first influence the ultimate cost to taxpayers and homeowners of the book of business originated before the housing crisis and the financial meltdown, and two, whether our housing policies decision going forward will ensure that credit-worthy borrowers will still have access to credit and be able to achieve the American dream of home ownership. I don't know anyone who has proposed that we return to a system of what amounted to first an implicit and then an explicit government guarantee. The Treasury Department's February white paper on housing reform calls for reducing overall government support for the housing market and winding down Fannie Mae and Freddie Mac. The key question is, what would a reformed housing market look like, and what role, if any, should the federal government have in that? As the Chairman mentioned, and we all know, the housing market is in a very fragile state right now. One proposal that's been advanced by Congressman Hensarling and 6 members of this committee would very quickly end any federal role in the housing market. I am very concerned that those proposals, which would create fire sales of GSE portfolios, would only further depress home values and reduce the return to taxpayers of the current portfolio at Fannie Mae, regardless of what cost accounting method we use. Those concerns are shared by many others, and Mr. Chairman, I ask unanimous consent just to put in the record statements from the home builders and the realtors, people who are, of course, intimately involved in the housing market.
Without objection.
And there's also bipartisan concern on that score. As you mentioned, there has been other legislation introduced that doesn't immediately wipe out any federal participation, but in fact allows federal participation to go forward in a much more responsible way. That's been introduced by Congressman Campbell, Gary Peters, and others, that preserves a limited government role and one that is designed to protect the taxpayers, but also allow for creditworthy borrowers to have access to the market. Others, like the Center for American Progress, have put forward their own proposals, and I commend them for putting something on the table. So, Mr. Chairman, I thank you for holding this hearing. I think the question of how we account for these costs is, of course, an important one, and I look forward to the testimony, but the real costs and the larger costs in the long run to taxpayers, homeowners, and the economy will be determined by the housing policies decisions that we make here in the Congress. So with that, I thank you, and again, thank you to the witnesses.
Thank you. Today we are joined by Dr. Deborah Lucas.
Mr. Chairman?
Yeah.
Can I just, before we get to the witnesses, I'd ask unanimous consent to submit for the record a letter from the National Association of Realtors?
Sure, without objection.
Thank you.
Anybody else want to submit anything? Sure, we'll have the clerk make photocopies and distribute it out.
Well, as long as you do it, I was going to do it at the end, but since you do, from the National Multi-Housing Council letter.
Okay, without objection. Anybody else want to submit something for the record? We'll send copies of this one around as well. You bet, absolutely. We're joined today by Deborah Lucas, the Assistant Director of the Financial Analysis Division, excuse me, I have a bad cold, from the CBO. Move away. Also, Alex Pollock, who's no stranger to this committee, a resident fellow at the American Enterprise Institute, former chair of the Chicago Federal Home Loan Bank, if I'm not mistaken, and Sarah Rosen Wartell, did I get that right? Sarah Wartell, Executive Vice President from the Center for American Progress Action Fund. Why don't we just start with Deborah and then move over?
Is the microphone on?
Your mic on and put it right in front of you.
There we go.
There we go. That's
Okay,
better.
so thank you. I appreciate the opportunity to testify about CBO's estimates of the budgetary cost of Fannie Mae and Freddie Mac and the options for the future role of the federal government in the secondary mortgage market. In CBO's judgment, the federal conservatorship of Fannie Mae and Freddie Mac and their resulting ownership and control by the Treasury make them effectively part of the government and imply that their operations should be reflected in the federal budget. Hence, in its baseline budget projections, CBO accounts for the cost of the GSE's operations as though they're being conducted by a federal agency. Now, after consulting with the House and Senate budget committees, CBO concluded that using a so-called fair value approach to estimate those costs would give the Congress the most accurate and comprehensive information about the budgetary costs of supporting the GSEs. A fair value approach provides estimates of the value of the GSE's assets and liabilities that either corresponds to or approximates prices in a well-functioning financial market. Using that method, back in August of 2009, CBO estimated that the net cost to the government of all of the GSE's outstanding mortgage commitments made through the end of 2009 would total $291 billion. Now, since that time, CBO hasn't updated its estimate of the cost to the government of those past commitments. However, the GSE's financial reports suggest that losses on those obligations may have increased somewhat since that time because of the continued weakening of the housing markets. Okay. So looking forward, in its recent March 2011 baseline projections, CBO estimates that the new guarantees the GSEs will make over the next decade will cost the government $42 billion. The subsidy rate for the GSE's new business has fallen since the peak of the financial crisis, and it's projected to decline further as conditions in the housing market and the economy improve. However, under a fair value approach, the subsidy rate will remain positive as long as Fannie Mae and Freddie Mac provide guarantees at prices below what private financial institutions would offer. Now, unlike CBO, the administration's Office of Management and Budget treats Fannie Mae and Freddie Mac as non-governmental entities for budgetary purposes. That implies that in the budget, OMB records only cash transfers between Treasury and the GSEs, such as for stock purchases and dividend payments. That approach can postpone the recognition of the costs of the GSE's new guarantee obligations for many years. The fair value approach that CBO is using for projections is also different than the procedures specified by the Federal Credit Reform Act of 1990, otherwise known as credit reform, which applies to most federal credit programs. Unlike credit reform estimates, which use Treasury rates for discounting, fair value estimates use discount rates that incorporate a risk premium. The inclusion of a risk premium recognizes that the financial risk to the government that it assumes when it issues mortgage guarantees represents a cost to taxpayers. Now, those two approaches paint very different pictures of the cost of continuing to operate Fannie Mae and Freddie Mac under current law over the next decade. Whereas on a fair value basis, their new obligations generate a budgetary cost, under credit reform, the continuing operations would result in budgetary savings. Currently, fair value accounting is used for the Troubled Asset Relief Program and by CBO for the GSEs, but the credit reform approach is used for most federal mortgage guarantee programs, including the Federal Housing Administration's single-family mortgage insurance program. CBO recently estimated the difference between the two methodologies as applied to that FHA program. Under credit reform, the FHA program would produce budgetary savings of $4.4 billion in fiscal year 2012, but on a fair value basis, the program would cost $3.5 billion in the same year. That different budgetary treatment of the GSEs and FHA means that a mortgage that generates a budgetary cost when it's guaranteed by Fannie Mae or Freddie Mac could show budgetary savings if FHA provided the coverage instead. While policymakers are contemplating a wide range of proposals for the federal role in the secondary mortgage market in general, for the future of Fannie Mae and Freddie Mac in particular, and for the transition path to a new model. In a recent study, CBO analyzed those alternatives and the trade-offs among them, and my written statement summarizes that work. Any new approach would need to confront major design issues. If the approach includes federal guarantees, how to structure and price them, whether to support affordable housing, and if so, by what means, and how to structure and regulate the secondary market. Options will need to be evaluated using several criteria, including whether a given alternative would ensure a stable supply of financing for mortgages, how affordable housing goals would be met, how well taxpayers would be protected from risk, whether the federal guarantees would be priced fairly, and to what extent the approach would provide incentives to control risk-taking. Well, whichever direction is ultimately chosen, the policy choices will have budgetary implications that could differ considerably depending on the budgetary treatment used. In CBO's judgment, continuing to use a fair value approach to estimate subsidy costs for Fannie Mae and Freddie Mac would provide the most accurate measure of the cost to taxpayers of any eventual transition to a new federal role in the secondary mortgage market. However, doing so would maintain the practice of accounting for similar federal credit programs and financial transactions in different ways. Thank you.
Mr. Pollock.
Thank you, Mr. Chairman, Ranking Member Van Hollen, and members of the committee. Over the past 4 decades in this country, we've engaged in a truly remarkable financial experiment or adventure of exploding agency debt, which is described in the graphs and the discussion in my written testimony. This explosion, in my view, calls into question old ways of thinking about, accounting for, and managing such debt. The vast debt of the non-budget agencies and government-sponsored enterprises, most of which is devoted to subsidizing housing finance, fully relies on the credit of the United States. This means, by definition, it exposes taxpayers to losses, but as we know, it's not officially accounted for as government debt. This debt puts the federal budget at risk, or more precisely, subjects it to major uncertainties and potentially huge credit losses, as we've experienced. Indeed, it represents a kind of off-balance sheet financing and risk-taking by the government. Fannie Mae and Freddie Mac, in particular, can quite reasonably be thought of as government SIVs or SIVs. And the analogy to, say, the SIVs used by Citibank to try to finance mortgages off balance sheet is quite a tight analogy. In 1970, so 40 years or so ago, Treasury debt held by the public was $290 billion. Seems like a small number these days. And agency debt was $44 billion, so 290 versus 44. By 2006, at the height of the housing bubble, Treasury debt was almost $5 trillion, but agency debt had inflated to $6.5 trillion. So over this time, while Treasury debt had increased 17 times, agency debt had multiplied 148 times. This created an altogether new and unprecedented situation in government finance. In 1970, agency debt represented only 15% of outstanding Treasury debt. By 2006, this had inflated to 133% of Treasury debt. So if you were managing the Treasury debt, you were managing less than half of the government's credit exposure. If we add these two types of debt together, we get what I call effective government debt, that is, debt dependent on the government's credit, which is held by the public, and this number is now nearly $17 trillion, as shown in my written testimony. How was this agency debt explosion possible, we should ask? The financial reality is that bond salesmen peddling trillions of dollars of Fannie, Freddie, and other agency securities to investors all over the world said to them something very much like this: you can't go wrong buying these because they're really U.S. government credit, but they pay you a higher yield, so you get more profit with no credit risk. And although this description was disputed by various official voices, in fact, what the bond salesman said was absolutely right, as experience has demonstrated. It was a good deal for the bond buyers, but it was hardly a good deal for the taxpayers. How can we better think about the risk to the taxpayers represented by the explosion of agency debt? For entities subject to the Federal Credit Reform Act, the expected, or that's really the best guess, estimates of losses must be reflected as costs in the federal budget. This requirement is useful, but it does not address the fact that we do not and cannot know what the losses will turn out to be. As the Congressional Budget Office points out, the FHA, for example, has often had to significantly increase its credit loss estimates, which it worked so hard to make in the first place. The CBO correctly states, quote, "The expected cost of defaults does not account for the uncertainty about how costly such defaults ultimately will be," unquote. I concur with the recommendation that the budget cost analysis should reflect the reality of this uncertainty which is imposed on the taxpayers. The explosion of agency debt means that managing the issuance of Treasury securities, as I said, has come to deal with only about half and often less than half of the effective government debt. Now, this brings me to two statutory recommendations. Congressman Van Hollen asked about the government role. In my view, a key government role is for the government to manage its own credit, all of its own credit exposure. And this means that the Treasury Department should be firmly in control of the government's credit and its use by the off-balance sheet agencies. So I propose that we return to the logic, we remember the logic of the Government Corporation Control Act of 1945, an act still in force. This act spells out the responsibility of the Treasury Department to control the debt expansion of government corporations with notable rigor, and I cite the language of the act in my written testimony. There is no doubt whatsoever that Fannie and Freddie are now mixed ownership government corporations. So I recommend that Congress should amend the Government Corporation Control Act explicitly to add Fannie Mae and Freddie Mac to the list of mixed ownership government corporations in that act, thus formally subjecting them to the appropriate financial discipline of the Treasury. A second useful reform was to find in the Revenue Act of 1992, passed by the Congress, but not enacted due to a veto for other reasons. This provision would have forced the Treasury Department to focus on how agency debt affects the cost of treasuries. It required an annual report to Congress on that question. And in my view, there is no question that the explosion of agency debt increases the cost of treasuries. It raises the interest rate on treasuries by creating a giant competing supply of government backed debt to compete with treasuries. How big this increased cost is subject to some debate. A recent Fed study suggests that by taking $1.7 trillion in government securities, of which more than $1 trillion were agency securities, out of the market, the rate on the 10-year Treasury was reduced by 30 to 100 basis points. This is a Federal Reserve brand new study. We put this logic and just apply it in reverse, adding $7 trillion of agency debt to the market, certainly, or at least plausibly, would have increased the cost of financing the Treasury by a like amount. So by increasing the cost of the Treasury, the agency debt actually increases the explicit government deficit by increasing the cost of financing the government. So in this Revenue Act of 1992, the provision, which is quoted in my written testimony, would require an annual report of the Treasury analyzing the extent to which the behavior of agency debt has increased the cost of financing the Treasury itself. Now, I recommend that this provision should be reintroduced and enacted. In these ways, and I'm sure there are others as well, we could help control for the future the exposure of taxpayers created by the use of the government's credit card by agency debt, the consequent uncertainty of the true budget cost, and the possibility of huge losses, and the over-leveraging of the housing sector, which uncontrolled agency debt promotes. Thank you very much for the opportunity to be here.
Thank you, Mr. Pollock. Ms. Wartell.
Good morning, and thank you, Chairman Ryan, Ranking Member Van Hollen, and members of the committee. I'm pleased to have the opportunity to testify today. Today's purpose is to examine how the budget reflects the taxpayers' cost of federal support for the housing market through Fannie Mae, Freddie Mac, and FHA. But before I speak to that issue, I want to put in a broader context. Right now, the GSEs in conservatorship and FHA are essential to stabilizing the housing market. Their new business is both prudently underwritten and most likely profitable, allowing them to make dividend payments to the Treasury, offsetting losses incurred on earlier obligations during the housing bubble, and so reducing the net cost to the taxpayer. First quarter Case-Shiller Index shows that the housing market remains very weak. Had the GSEs and FHA not been able to pick up when the private market withdrew, the housing collapse would have been far more severe and the recovery even slower, something we should remember as we think about the future. No one wants to sustain the current situation. Government bears the credit risk on over 95% of mortgages today. Going forward, private capital at risk must be made to bear as much of the load as is possible. But we must ensure that the private market is ready to pick up the slack before we withdraw federal support, or we risk deepening the cycle, the vicious cycle of falling home values and a shrinking economy. The taxpayers' exposure to risk from the books of business originated before the housing collapse by the GSEs is fixed. There's nothing we can do about it. Their exposure is fixed. But the ultimate cost of those obligations to the taxpayer is undetermined. The size of the losses that the taxpayers will pay will be determined in large part by the housing recovery, which in turn depends on the consistent availability of sustainable mortgage lending to the housing market. Limiting the GSE's role prematurely without a better designed mechanism to ensure liquidity while protecting the taxpayers would weaken the housing recovery and have the effect of significantly increasing the GSE's and FHA's losses on past obligations, and thus the cost to the American taxpayer. With that in mind, let me address the budgetary treatment of the GSEs. First, the cost to the taxpayers of government support for Fannie and Freddie is already reflected in the federal budget. There is an important technical debate between budget analysts about what is the best methodology to use to report these costs, and that debate in part hinges on whether the GSEs are now governmental entities or more like a bank that has been taken over by the FDIC, which is not treated as a governmental entity. And also, it hinges on what discount rates to use. Those are important discussions. But please, we should not suggest that they are not reflected in the federal budget. The cost to the taxpayers of those obligations are. The payments and revenues and the effect on the deficit can be found, in fact, on table S12 on page 201 of the President's FY 2012 budget, where OMB projects for 10 years the payments made under the preferred stock purchase agreements to bolster the GSE's capital position, and the dividend payments to the Treasury that are required under those agreements to be made in return. It also shows the balance of those two numbers, which is the program's net effect on the deficit. What is more, additional information regarding the financial position of the enterprises is reported in many places, including by the Treasury Department's audited financial statements, the enterprise's 10K filings with the SEC, and quarterly reports from FHFA, their conservator. In my written testimony, I detail the consequences of the OMB and CBO approaches and my concerns with some of the inconsistencies created by the CBO approach, which Ms. Lucas noted in her testimony. I ask that that full statement be submitted for the record. A second concern is that we must recognize why the budgetary treatment of the GSEs is so complex. We are talking about how to reflect in the budget today, when we have an effective guarantee of the GSEs, obligations that were incurred at an earlier time when the securities were not explicitly backed by the full faith and credit. This situation is unique, and it is temporary. There will be a transition to a new system, and the GSEs, as we know them, will be unwound. There is no debate among the administration, Congress, or any party that that will be the case. So what is far more important than a debate about the budget treatment of past obligations is to ensure that any future system of government support includes explicit terms, fees charged for any federal support provided, and reserves held on the books of the taxpayers to protect them against future losses. Any explicit guarantee in the future should be accounted for in the budget using standard treatment for credit liabilities under the Federal Credit Reform Act, and which establishes consistent ground rules for ensuring that the true cost of credit obligations are recognized when incurred. Personally, I support the availability of a government guarantee for liquidity targeted to support middle-class home buyers and renters. I am pleased to see that there is emerging some bipartisan support for this idea, with Representative Campbell and Peters offering their own proposal, which contains this core feature. But under any future plan, it is important that new guarantee obligations be treated under the same budget rules used for other federal credit programs. Not that the entities are, but the guarantee costs are, so that the costs and benefits can be compared across programs under consistent assumptions. Finally, let me close by commending the chairman and the committee for this hearing. This is technical stuff, but it implicates issues that matter to every American family, as Congressman Van Hollen mentioned. What is at stake in the housing finance reform debate is what kind of future is available to all Americans' middle-class families. Can credit-worthy borrowers get non-discriminatory access to a 30-year fixed-rate mortgage? What that means for their family is that they can provide their families with the security of a home of their own on terms that they can afford. Will they see wild swings again in credit availability and the resulting depression of their home values and their savings? Will new quality rental housing be built to meet the burgeoning projected demand, or will we instead see skyrocketing rents and limited choices for renters? Congress and the administration have the responsibility to design a smart system of housing finance for the future that both protects the taxpayers and achieves these goals. I thank you and would welcome a chance to answer any questions.
And I thank you for your testimony. I appreciate all the panel's testimony. And at this time, I'll yield myself such time, I guess, as I consume in this committee. Unlike financial services, where I'm limited to 5 minutes, I'm told by Paul before I left, I can just go on ad nauseum here. But I'll still not try to do that. So, Ms. Martell's, your comment at the end, you said this is technical stuff. But that's not any reason why we should not have transparency but what we're talking about. And I'll start with Ms. Lucas on this point. So we just had a hearing recently in financial services, and we brought up the letter to Paul that CBO wrote with regard to this issue that the panel has also addressed. And on the upside was the fact that there was agreement on everyone on the panel that, in fact, that there should be a reevaluation, if you will, of how the numbers are reported and to provide for more and greater transparency with regard to the budget and all. So that was the upside. The pushback, though, at least from one of the panelists, was that, well, maybe the CBO just didn't get it right. And looking back on the witness statement there it says the CBO may have been a little off and it used Fannie and Freddie fees and private mortgage fees as a determinant to how the market risk to FHA should be calculated. Would you like just to spend a moment to expand upon your analysis and why that pushback is not correct, but the CBO's analysis, what for fair value is the correct analysis for determining on budget?
Yes, Congressman, thank you. I guess where I would like to start is to say that, of course, any estimate of these costs is extremely difficult to get right. I'm not sure any of us would even know what right was when we saw it because it involves so many uncertainties. Remember that we're projecting the cash flows over the life of 30-year mortgages in a world where we don't know what's going to happen to housing prices, default rates, and so forth. So there's a great deal of uncertainty in these estimates, whether they're done under credit reform or on a fair value basis. I think what's fundamentally important is that CBO is striving to give an unbiased estimate to the best of our ability. So when we are trying to give these fair value estimates, the idea is that you're trying to reflect what the price would be in a well-functioning financial market. Now, that was a particularly challenging task for Fannie and Freddie, given how disrupted markets have been recently. But what we do is very much like the practice in private financial institutions that also have to struggle to do fair value accounting because they're required to do so. And it does mean looking at market prices and trying to understand what's driving those market prices and how much risk is embodied in those prices. So when we look at the private guarantee fees, we look for mortgages that are comparable in their risk to the ones that GSEs are doing. We make adjustments for differences in the borrowers, in the houses, and the leverage, and so forth. And so we try to come around to the best estimate that we can make of the cost of those guarantees, taking into account the cost of market risk as it's reflected in market prices. Now, I would be happy to provide you with a more technical answer to the question later on if you wanted more details.
That's pretty technical right there. So, but bottom line is that there should be an evaluation or appreciation of the fact that we're talking about mortgages here where there is market risk, and basically what CBO is trying to do is put that into the calculation, that the market is going, the valuation of these things are going to change over time, and that the obligation of us, the taxpayer, the federal government, is going to vary because of that over time. And you're trying to price that today so we understand what that cost is going forward. Isn't that, in a nutshell, what you're trying to do?
That's it. Okay. Exactly.
And absent doing that, you're really not giving a truly transparent answer to what the cost is to the taxpayer, to the government today.
Well, you're certainly not giving as comprehensive a measure of the cost. I mean, the view that this is important comes from viewing the taxpayer as the ultimate bearer of the risk that's coming from this. So if everything goes well, the taxpayers will be fine, but if we have another dip in the housing market, another recession, that's when defaults are likely to really hit. that's when those defaults are most costly, and that's the source of this market risk that taxpayers would require compensation to bear if they were investors. And that's the philosophy behind including that cost in these cost estimates.
And Ms. Wartell, although you say that there's all this information now that's published in other reports and what have you elsewhere, we don't treat that with, there's also reports on everything else that the federal government does elsewhere as well, but we still require the CBO and the OMB to actually put these things outside of here on budget so it's actually properly reflected as far as the obligations of the government. So why is it with just this one unique area that is satisfactory, that just because it's reported someplace else, it does not have to be it's not prudent to actually list it as on budget and what the cost is today? Why do you make this exception?
Well, I don't think it is exception. What I was arguing, in fact, is that the cost to the Treasury of these obligations, what they will pay in future support under the contract that they have with the GSEs, which is the Preferred Stock Purchase Agreement, those costs are projected and they are on the budget. Those, as well as the revenues that they anticipate receiving from the dividend payment.
But not the market risk is not on the budget.
Well, the market risk is embedded in their estimates of what the risk is embedded in the estimate of what those costs will be, because those costs will vary. The question, the difference between OMB's treatment and CBO's treatment ultimately hinges
But
on...
when you say that it's in CBO's estimate, it's not in OMB's estimate, that's in, it's not in...
Well, OMB's estimate has a measure of risk. The difference between CBO and OMB's estimate is whether or not they use a discount rate that is the rate that is charged to the Treasury, what Treasury obligations essentially can be purchased at, versus what a private actor would be charged. Now, because there is no private actor with this capacity, it's an estimate of what that would be. We do know what the Treasury rates are. But the other problem is that the federal government is not a private actor. The federal government has, we know its fixed costs, which are borrowing at Treasury costs, and the federal government, no one else has the capacity to borrow, and no one else has the capacity to spread risk. So what the use of that discount rate does is it's an attempt to value to estimate what the value of that risk is, but not necessarily the cost. And that's the technical debate between analysts as to whether this is a more precise estimate of the cost.
And mindful of my time and willing to let others, Mr. Pollock, I'll let you proverbially have the closing word on this comment.
Thank you, Mr. Chairman. The economist Frank Knight, almost 100 years ago, famously and correctly distinguished between risk, which are odds that you know, and uncertainty, which means you don't know what's going to happen. As I interpret this discussion, it's about the uncertainty which inevitably comes into the picture when you're extending credit and when you're financing things. So if you knew what the losses would be by a best guess estimate or estimated loss, and you knew that's what the losses were, then it would be very easy. You have the Credit Reform Act procedure. The problem is you not only don't you know it, you can't know it. And I think as I interpret the CBO's recommendation, they're trying correctly to take into account the inherent uncertainty that these losses may be much greater than anybody's previous best guess. We've experienced that many, many times. And there's one final point, which is the very fact that you think you know what the losses are going to be, as we just saw in the housing bubble, induces you to extend more credit, to run up the risk further, and to make the losses bigger. And all of that, while hard to do in a precise way, is directionally what the CBO is trying to do, and I think that's correct.
And I thank you. Mr. Van Hollen?
Thank you, Mr. Chairman. Again, I want to thank all the witnesses for their testimony. I want to stay on the technical point for a minute and then get to, I think, the larger question of where do we go from here. And, Mr. Chairman, I do want to submit from the record the OMB, portions of the OMB budget. Page 201, it talks about the market valuation and balance sheet of Fannie Mae and Freddie Mac, and I understand Ms. Wartell's testimony to be those risks are embedded in their analysis and their projections with respect to the budget numbers that they have submitted. Ms. Wartell, in your testimony, you talked about the fact that if we're going to apply this other approach to measuring the risk and costs, that we need to do it uniformly across all credit programs. And just a quote from your written testimony says, "It would be irresponsible for Congress to cherry-pick individual credit programs to be subject to special budget rules. This would make some programs appear more expensive than others when really they are calculated using entirely different measures of costs. It's like comparing two products priced in different currencies without considering the exchange rate." Could you elaborate a little bit on that?
Yes, that reference was to the discussion about FHA and whether or not FHA, which is a federal government program, there's no controversy there, should be evaluated using the fair value method versus the methodology that's used under the Federal Credit Reform Act. And I think there are 2 points there. The first is that consistency is enormously important because the ability to weigh the different priorities of Congress requires you be able to treat like items alike. The second point, though, is that it is perfectly appropriate for us to have supplemental information about FHA or other credit programs that get to this question of variability of risk, because housing markets are different than energy markets that we also guarantee. But we should be looking at the cost to the taxpayers of those programs using similar methodologies.
Thank you. Ms. Lucas, would you agree with that?
I certainly would agree with that. In fact, one of the stated purposes of the Credit Reform Act was to put credit on a level playing field with other commitments that the government makes. And I think one of those problematic things going on right now is that different treatments are being used in different places. Just to mention that Ms. Wartell said that what OMB is doing right now is under credit form, but for the GSEs, it's actually using a cash basis of accounting in the budget. So right now, we have an inconsistency between cash and even credit reform for the GSEs. So the GSEs, as they're being accounted for now, are not comparable with the FHA either in the way the administration is accounting for them. But certainly being consistent is extremely important. The GSE accounting is consistent with the way TARP was accounted for, and those obligations sort of arose in connection with the same problems that led to the TARP. So there was a consistency there, but there's inconsistencies in other places.
Okay. Ms. Wartell, if you want to briefly respond to that.
You're right about the reference to Fannie and Freddie. The question of consistency then determines whether or not you believe that Fannie and Freddie are like FHA in their current situation. Are we treating them consistently? They were private entities with private shareholders. They are now mixed ownership because the government owns a portion of them. But they are entities that are being wound down in their status. And we do not treat other entities being wound down like the banks that are resolved by the FDIC that way. And so we have, in our striving for consistency, there are multiple facets in which we're striving to be consistent. And on that regard, the treatment of the GSEs, like FHA, makes them inconsistent with other things that are also temporary in nature.
Mr. Chairman, I think we members of this committee are getting a good sense of just how technical this issue is. That doesn't mean it's not important. It is. I think we would all agree we want the most transparent and accurate assessment of the cost to the taxpayer, and so we obviously will continue to pursue that. But the larger costs in the long run, as has been said by some of our witnesses, and I mentioned our opening statement, is how we respond to the current situation, because there are certain actions we could take that I believe would dramatically cost the taxpayer more, both in terms of the obligations that we've already signed up to, but also would hurt the availability of credit for credit-worthy borrowers going forward. And so, Ms. Wartell, if you could just briefly explain what you think the consequences would be of 3 proposals. One proposal is that introduced by Mr. Hensarling and a number of members of this committee. The second, and I know Mr. Campbell has an interest in this, the one that he introduced that has bipartisan co-sponsorship, and then the proposal that you have advanced at the Center for American Progress.
Well, I think the nut of the Hensarling proposal is an effort to unwind the GSEs, but not to replace them with any form of targeted government liquidity backstop in the future, and to do it quickly. And the speed is of particular concern because of the current fragile state of the housing market. If you were to disrupt the expectations of investors, people would worry now that a house that they buy today, no one will be able to get a mortgage on similar terms if there's no GSEs in the future. So they will be worried that they won't be able to sell it for what they purchased it for. That will deter purchases in the housing market, and that will deflate values. So my fear is that if Congress were to give serious consideration to that legislation, the market today would begin to price in some of those risks. And the effect of that would be to make our current economic fragility even more extreme. The Campbell-Peters bill and others represent this notion that there should be a limited, targeted liquidity backstop standing behind private capital that is fully at risk, meaning that private investors have to lose all of their money before any government insurance, and it also embodies the notion that there would be a charge paid for the government standing behind it that would be built into the cost of the mortgage, and the government would collect that money and hold it as a reserve fund, but would leave liquidity available, not for jumbo mortgages and high-end mortgages, but for the mainstream middle part of the market, so there's consistent availability. That will allow house prices to resume their normal appreciation based on underlying economics. That approach, it seems to me, goes us a long way towards moving forward in the housing market. This cap proposal that was developed by our Mortgage Finance Working Group takes the nut of the Peters-Campbell proposal, but also includes with it some obligations to ensure that all of our communities have access to credit. One of the consequences of this unfortunate foreclosure crisis is that particular communities that were targeted by some prime lenders have seen equity stripped, and where there are high concentrations of foreclosures, it's going to take a long time for housing values there to recover. And so we create an obligation to ensure that the private market would serve all of our communities with access to credit, and to the extent they can't do it profitably, there'd be a shared risk with the taxpayers on budget, priced under federal credit reform, that we think will ensure that we recover most quickly, but at the same time limit the taxpayers' exposure from the future.
And then I guess it's appropriate to follow that line of questioning with the gentleman from California.
Thank you, Mr. Chairman, and thank you all for being here. It's been said many times, there's no debate or discussion that Fannie and Freddie as they exist should be wound down, and that we want to account for them accurately and transparently, and that we want to reduce that cost to the taxpayer. Nobody disagrees with that. So I'd like to focus on, obviously, the future and what we are going to replace Fannie and Freddie with, and what consequences that may have. So Dr. Lucas, starting with you, if we have, as Ms. Wartell described, something that is a explicit limited federal guarantee behind a lot of private capital, and for that guarantee there is a market charge, not dissimilar from FDIC insurance, the way that works. CBO in that sort of instance, something like that could score at zero or little or low cost. Is that correct? Not asking you to score the proposal at this time, but just in concept, that kind of thing.
It's certainly true that the more private protection there is in front of the government, and the less likely it is that the government will see losses, the lower the estimated score would be.
And you mentioned in your testimony about one of the problems with Fannie and Freddie, is that there was no charge for what was implicit and became explicit. In this case, there would be a market charge.
That's right. So, unfortunately, the term market charge brings us squarely back to the ugly technical discussion we were having earlier, because one person's view of what covers the cost to the government is different than the others. If in my mind, a market charge would include a cost for the risk bearing, and as you said, it wouldn't be particularly large if the government was protected by a lot of private capital and by the value of the houses and so forth, good underwriting.
Okay. Let me go on to one of them. If we were to withdraw any government support, and wind down Fannie and Freddie and withdraw any government support. And that resulted in a drop in housing prices. That would put further taxpayer money at risk in the Fannie and Freddie portfolios that exist, correct?
Yes, it would.
And that could potentially cost the taxpayers money.
Yes, it could.
Ms. Wartell, I think you testified kind of to this degree, that if we were to wind down Fannie and Freddie, replace them with nothing, no government support, and the 30-year fixed rate mortgage as we know it vanished, which means that people would pay more money per month for the same house. And the only way that can happen is if there is a significant and matching decline in housing prices. And so if that then occurs, it could cost the taxpayer a lot of money. So by replacing it with a system, as Mr. Peters and I have introduced, we could actually be saving a lot of taxpayer money, both with the Fannie and Freddie portfolio and in terms of what that kind of drop in housing, which is 1/7 of the economy, would do to the overall very fragile recovery. Your comments?
I would agree with that. I think that there is a real concern that our housing prices today assume the lesson we learned after the 1930s, which is that there will be consistent availability of mortgage credit that was built into the prior system. With all its flaws, it did, in fact, until we had the explosion of the private label securities market outside of that system, we did, in fact, avoid bubble bust cycles. If we go back to a world without that consistent availability and the potential for bubble bust, it will make people much more reluctant to invest, and the effect of that is to make housing. I would also add another point. I think that one consequence of that system, without any private, without any government liquidity backstop to an otherwise private market, is that a great deal more of the market would land in FHA. FHA is 100% government guarantee. That means that we charge premiums for it, but we stand behind the whole mortgage loss. There's no credit risk on the part of the lenders. So it seems to me that privatization scheme actually will shift a significant portion of the market to government with no private credit ahead of us, and that seems to me exposing us to more loss, not a lot less.
Thank you. Mr. Pollock, and I have very little time, but you seem to stand out in believing that if we withdrew the federal guarantee and replaced it without and had no replacement, that somehow that's not going to cause problems for the economy, for taxpayers, and for housing, that somehow the elimination of the 30-year mortgage as we know it, or a 40% down payment, as you have suggested in some of your work, is somehow not going to have a very negative impact on housing, very negative impact on the economy, very negative impact on revenue, and therefore on taxpayers with their Fannie and Freddie portfolio? Come on.
Let me back up a minute, if I may, Congressman, and look at the result of the GSEs and the explosion of agency debt, which was to create hyper leverage in housing markets and housing finance markets. Hyper leverage in particular.
Mr. Pollock.
Wait a minute.
And my time is over, so I don't know how the chairman wants to handle it. But
let's let him
we're not
finish.
proposing to replace the GSEs with the GSEs. No one in this room is proposing that. So don't go to a failed model to describe what a future entirely different model might look like.
So let him answer your question.
Congressman, with respect, I agree. We don't want to go to the failed model, and we certainly don't want to repeat the failed model. Neither the 30s model, which created tremendous housing busts in the 1960s and 70s, nor the GSE model. Remember that this theory of having private capital in front of government risk was exactly the theory of Fannie Mae and Freddie Mac. And in the 1990s, when their risk-based capital was set up, the theory was that this risk-based capital would allow them to survive a new depression. Obviously, it was all wrong. The government never prices risk right. It doesn't price it right in the FDIC. That's why the FDIC's net worth was vastly negative. It doesn't price it right in pension guarantees. It doesn't price it right in housing. It doesn't price it right in flood insurance. It never prices it right. What we need to move to, and where I think we would agree, is we need to move in a coordinated transition, which we have suggested would be a 5-year transition to solve the problems that you point to, problems largely created by the past mistakes of this design. We need to go through a 5-year transition, the end point of which is we move to a largely private mortgage market where the prices are market prices. I have no doubt there will be a robust 30-year mortgage in that market. And
That, no doubt, is not shared by anybody in the marketplace who might actually fund those 30-year fixed-rate mortgages, by the way.
Well, if, with respect, we could discuss that more later. And the final point would be we would bring the government, or we need to bring the government, as I said in my testimony, into control of its own credit, not hand it over to uncontrolled agencies which run around with the government's credit card.
Thank you. Gentlelady, recognized.
There it goes. Thank you, Mr. Chair. In my district and throughout the United States, communities are still struggling. The repercussions of the housing crisis are still being felt by too many homeowners, and this is great reading, the Financial Crisis Inquiry Report. And so I'm just going to kind of refresh the housing bubble here from page 422. The housing bubble had two components, the actual homes and the mortgages that financed them. And they look briefly at the components and its possible causes. It goes on to say, conventional wisdom is that a bubble is hard to spot when you're in one, and it's obviously painful later after it's burst. Even after the U.S. housing bubble burst, there's no consensus on what caused it, but they go on to list a couple of things that they went into detail. Population growth, land use restrictions, over-optimism, easy financing, and they go on to explain that. Now, just recently, Standard & Poor's found that single-family homes dropped to their lowest level since 2009. Even more troubling to me is in the 20 metropolitan areas that they looked at, housing prices in the Twin Cities had the biggest drop, which is very unusual for the Twin Cities. Compared to March of last year, prices fell 10%. In my community, making it the only area to see a double-digit drop. Well, it's important that we understand the causes of the 2008 housing finance market collapse. It's equally important that we enact smart reforms to ensure it doesn't happen again. There seems to be consensus on part of the solution of restructuring Fannie and Freddie that in a way that protects housing opportunities for middle-class families, but also limits taxpayer risk, as Mr. Campbell was describing. The second, equally important part is ensuring that Wall Street reforms passed last year are fully enacted. So the second part is where I want to focus on my question, because I think we've heard a lot of talk about repealing the financial regulatory overhaul passed last year, as well as weakening the consumer protection. In fact, Republicans who want to protect taxpayers from bailouts, yet their budget intends to take the cops off the Wall Street watch here by cutting the SEC, the CTFC, and completely eliminating the Consumer Finance Protection Bureau. So the very agencies charged with making sure that big banks that play by the rules when it comes to issuing mortgages and other credit products, there's no one watching the fox in the hen house. So I have a question, and my question is directed to you, Ms. Wartell. I'm interested in hearing what steps are needed in addition to reforming the GSEs to ensure that similar crises are avoided in the future. Particularly, what would happen to the housing market if Fannie and Freddie are completely privatized and the Dodd-Frank Act is not implemented? And after you're done answering that question, if there's any time remaining, I would yield it to the gentleman from California if he has any further rebuttal to make.
Yes, thank you, Representative McCollum. I would make 2 points. I think, first of all, as we were talking about earlier, if we simply unwound the GSEs with no replacement, I think we face a real risk of returning to the period of time of real wild swings in housing prices, not simply regionally as we've had in the past, but nationwide. And that was the experience in the 1930s. The United States housing market enjoyed between the 1930s and the 1990s, certainly ups and downs, but there was never a time in which mortgage capital was not available. FHA was there as a backstop during the oil patch crisis, et cetera, and that availability of crisis helped to ensure that these swings were not as extreme. That allows people to invest and use in home ownership, have the community benefits that we get from home ownership, and also the opportunity to participate in the wealth savings that home ownership has provided for American families, the forced savings, if you will, that home ownership provides. To your question about implementation of Dodd-Frank, I would just note that specifically as to the housing market, the Dodd-Frank legislation has a number of important regulatory actions that are currently pending. Members of this committee who feel strongly that we need to get the private market to be back bearing more of the risk in the housing market have a strong interest in having those regulations completed. The qualified residential mortgage definition and the QM definition, the qualified mortgage definition, both of those are, right now, the private market doesn't know what the ground rules are going to be. When those regulations are in place, we'll have clarity about the ground rules, and I think you will then see the beginning of private label securities markets serving the top end of the market and have the capacity, as we withdraw the GSEs from the upper end of the market, to take over more of that. If we don't complete those rulemakings, the ability to shift some of this risk from the public sector to the private sector will be limited. So I would argue implementation of Dodd-Frank is extremely important to getting the private sector to serve more of our housing market today.
Thank you. The gentleman from South Carolina.
Thank you, Mr. Chairman. Very briefly, a couple of comments. I want to get beyond the technical aspects of it and come back to what's actually happening here. Mr. Pollock, let me walk through these scenarios and tell me if I've got this correct. If a private lender issues a non-conforming loan, say a jumbo loan, that has no government backing at all, and the homeowner defaults, just doesn't pay their mortgage, it is the lender who bears the brunt of that, correct?
Correct.
The lender ends up losing their money in that particular transaction. However, if we're in an FHA-backed situation, the lender lends the money to the homeowner is unable to pay. Tell me then, Mr. Pollock, who bears the brunt of that?
The FHA.
Which is ultimately the taxpayer of the United States of America, correct? And I think that's what's lost in a lot of this discussion, is that that's essentially what we're doing, is that we're asking the taxpayers to help subsidize people who don't pay their mortgages. And I think that gets lost in a lot of the detail about this discussion. What you brought to my attention today, Mr. Pollock, was something I had not considered before, which was the indirect impact of the agency debt on the overall interest rate environment. Was it your testimony, I think, that your estimate was someplace between 30 and 100 basis points that we're paying higher on our public debt because of this huge agency debt? Did I get that right?
That's correct, Congressman.
And I think this committee has heard testimony several times from the CBO and other folks that an additional 100 basis points on what we pay for our debt when the debt is $14 trillion is roughly $1.4 billion. Excuse me, $140 billion. I'm going to get this right. $1.4 trillion over the decade. So the taxpayers paying there. And I think what we lose track of here is that we all talk about propping up the housing industry. And listen, I'm a home builder, so I understand the importance of this particular industry to the nation. There's no question about it. But what we're doing is essentially shifting a tremendous burden onto the taxpayer. I want to address Mr. Campbell's point very quickly, and then I want to ask one question about the 30-year mortgage. Mr. Chairman, I would suggest that what my colleague from California is suggesting, along with folks on the other side of the aisle, is that this time we'll get it right. We know we screwed it up before. We know we've done a really, really lousy job in doing this in the past, and it's cost literally trillions of dollars, but this time we're going to be much smarter in doing this than everybody else who's been here before. And that's all that I hear again is, well, we know we screwed this up, but boy, if we do it right this time, it's really, really going to work. And Mr. Pollock, I think you hit the nail on the head when you said that government can't do that because it doesn't know how to price risk. And that's because we don't price risk on a market-based assessment. We price risk on a political-based assessment. We make political decisions about what things cost as opposed to free market decisions about what things cost. That's a lot of talking for me. I have a legitimate question for everybody on the board, which is I've heard a great deal of discussion about the possible existence or non-existence of the 30-year mortgage that so many of us are familiar with. I've heard arguments that it will go away if we get rid of the GSEs and don't replace it, and then I've heard arguments that it will not go away. I was always under the impression when I was in the industry that the reason for the 30-year mortgage was in large part because of the 30-year Treasury bill or Treasury note. And my understanding is that that's not going away anytime soon. You all have a minute and a half each or a minute left each. I'd love Ms. Wartell to tell me why you think the 30-year is going away, and then Mr. Pollock to tell me why you think it's not.
The 30-year fixed-rate mortgage requires a lender, if there's not access to a secondary market investor or the ultimate investor, to hold out their money for 30 years. And on terms, if it's fixed rate, that are set at the beginning of that 30-year period. That's a great deal of uncertainty about how interest rates will shift. And the most market investors are unwilling to leave their obligations out for that long without knowing where interest rates will go. They will at a price. And I think that Alex is right when he says that the 30-year fixed-rate mortgage will be available. But it will not be available, in my view, at a price that most middle-class American families will be able to afford. Those mortgages that Alex will cite that are available at that price tend to be for very, very, very high-quality borrowers with very high down payments. Most Americans don't have those terms and conditions.
Congressman, there are private fixed-rate mortgages that have 30-year terms. There has not been in this country a middle-class private 30-year mortgage securitization market for prime mortgages. Now, this is a puzzle which we'll solve readily, but the puzzle is it is the most logical market that should have developed as a secondary market, prime 30-year middle-class mortgages. Why don't we have it? We don't have it because the government, in the form of Fannie Mae and Freddie Mac, crowded out the private market. And there are big pools of money in this country and all over the world who are long-term investors who are looking for what we call long-duration securities. Duration, and they buy long-term corporates, they buy long-term governments, they buy long-term infrastructure bonds, they buy long-term municipal bonds, and they'll buy long-term mortgages as well.
Thank you. The gentleman from New Jersey.
I thank the gentleman from New Jersey, Chairman. Mr. Campbell, unfortunately, many of us on this side, not all of us, agree with your analysis, so I hope it doesn't doom whatever you're going to forecast. We get the idea. We understand. Ms. Rosen Wartell, you say on page 8 of your testimony, the Treasury discount rates are used for credit reform and an approximation of a private sector equivalent discount rate is used for the fair value reporting, and you discussed that on page 5 in your remarks. Regardless of whether they're discounted by Treasury rates or a private market premium, the cost estimates will still be grounded on the same market forecasts. Biasing the estimates high will not change the economic reality in which FHA has to operate. It will, however, overstate the cost of operating the FHA program so as to encourage misguided opposition and drive legislation to constrain its growth. But whatever the process, you say, it is imperative that Congress apply the same budget rules to FHA loan guarantees as it does to all other federal credit programs. Am I stating your position correctly? So I do believe in what Mr. Campbell has stated as an analysis of the program. What I think your analysis is right on. I would like to know, Ms. Rosen Wartell, what would this piecemeal approach, which I am reluctant to embrace, and apparently you are too, we've heard what it would do to the 30-year mortgage. You've been pretty specific about that. What would it do to the following three things? Quickly, consumer protection, first-time home buyers, and multifamily units. Give me one or two sentences on each.
And to be clear, this is not about scoring. This is about unwinding the GSEs in a piecemeal fashion. First of all, I think one of the things the GSEs have done is they've provided standard terms and conditions for most of the market until we had the private markets take their place. Those standardization helps make it far easier for consumers to shop and compare. They couldn't do that during the private label subprime boom because everything was so confusing. That hurts consumers. To first-time home ownership, down payment is the single greatest barrier to first-time home buyers. It's very hard for people to save, particularly with stagnant wages over the last decade. And the availability of low down payment lending to well-qualified borrowers will be made more difficult in the world that has been described. Thirdly, multifamily.
Excuse me, what would exactly be made more difficult?
If we have only private investor
Right.
loans,
Yes.
at a price affordable to home buyers, low down payment lending that requires 5% down payment for borrowers who are otherwise well qualified, who have good credit, would be far more difficult to get. Its prices would be higher. I think the availability of would be diminished. Multifamily?
Yes.
It's very important to remember that the GSEs during the crisis also provided an enormous amount of liquidity for the rental market. For demographic reasons, we are going to see a huge increase in demand for rental housing over the next 20 years, and we have had a complete shutdown in the supply for a significant period of time. One of the reasons families with 3 kids bought homes was because there wasn't decent rental housing that they could afford, and so they stretched themselves to become homeowners. Without a mechanism for liquidity for long-term finance for rental housing, we will also see increasing pressure on rents and difficulty in homeowner.
Okay, thank you so much. Mr. Pollock, how would you expand consumer protection in your protocol?
Thanks, Congressman. First of all, let me say I believe the greatest obstacle to first-time home buyers is inflated house prices. And inflated house prices have reflected, among other things, all the government subsidies flowing into housing. So we're doing a disfavor to first-time home buyers by subsidizing house prices. So one way to protect them would be not to do that. Secondly, I have discussed for years a theme which the nascent Consumer Financial Protection Bureau has picked up, which is simplified, clear, straightforward mortgage disclosure, which I do think would be a major improvement. You certainly don't need a new government agency which is free of the discipline of appropriations to get that. But to get that simplified disclosure, I think, is something that we could all agree on. It turns out to be hard to do, to make things clear and simple, but it can be done.
Thank you for your contribution. Thank you, Mr. Chairman.
And I thank the gentleman from New Jersey. Gentleman from Indiana.
Dr. Lucas, I believe it was Ms. Wartell spoke earlier of the incongruity of using one sort of accounting analysis for one particular government program, and then a different sort of accounting analysis for different government programs. Why, in your mind, is it appropriate to use a fair value analysis for the housing market and using a unique accounting method just for this sector in terms of how government keeps its books?
Okay. Well, I don't think, I didn't mean to imply that it is appropriate to use a unique accounting treatment for any sector. And I believe that we want to move towards an accounting treatment for all credit obligations that give Congress the best picture of what their true cost is. The way that we got to fair value for the GSEs really started, I think, with the treatment of TARP, where fair value was required because had it not been, it was possible that TARP would have appeared to make money for the government, which didn't seem like perhaps the best way to account for it. So, but I mean, that's, so for the GSEs, there was a number of considerations, many of which are illegal, many of which I don't want to go into detail on because I don't think I'm the best qualified to describe it. But basically, the GSEs were difficult. They didn't fit into any natural bucket. The budget has two choices, basically, cash and credit reform. Cash didn't seem appropriate for the reasons I discussed in my testimony. It doesn't give a sense of the obligations going forward and so forth. The Credit Reform Act was also problematic. There were some contradictions between the GSE's charter acts and the Credit Reform Act that didn't quite reconcile. But I think, but beyond all that, I think that that fair value treatment does give the most comprehensive picture of what the costs are, and that ultimately was why we settled on that for the GSEs.
Chairman, could I just add a footnote there? It's my view that there is a big difference between the housing finance activities of the government and these other things, in that the housing finance activities are so much bigger. So in a day when the total agency debt was 15% of the Treasury market, you probably didn't care that much. But when it's as big as or bigger than the whole outstanding stock of direct government debt, you care a lot, and I think it gives us good reason to focus on them independently as opposed to a lot of many smaller things.
It would seem logical and consistent that, frankly, in other sectors, in other areas of government-backed finance, we would also try and incorporate market risk, right? I mean, that's a counter to the argument that I frequently hear, which is that we have an inconsistency here. Perhaps we do, maybe all the more reason towards embracing a fairer value sort of method of accounting for other areas, but I know that broadens the conversation here. Mr. Pollock, under the current cash accounting method that FHA uses, government makes a profit. That's correct, sir, right? According to our books?
Well, actually what FHA does under credit reform is to estimate its future losses, which is a kind of an accrual, and have to book those. Whether you call it a profit or not is a little tricky because we don't charge the FHA in the accounting for their operating expenses. Those are separately appropriated and separately budgeted. So all these numbers we've been talking about, unlike with a normal company, you don't, or a normal insurance company, we don't count the cost of actually operating the programs, as the CBO correctly points out. So one of the things I'd like to see as a supplementary FHA account would be a set of GAAP books that actually measures the profit and loss of the insurance business of the FHA the same way we would measure any other insurance company.
It seems curious to me. Couldn't the government actually improve its balance sheet if we mandated that the United States government had to insure every loan in the mortgage marketplace, right? I mean,
well, that's the reductio ad absurdum, if I could use this, the reduction to absurdity of the argument that, of course, we make profits, and the more we guarantee, the more profits we make. And, of course, the more we do that, the less market discipline, the less efficient is our resource allocation, and the bigger the ultimate collapses tend to be.
Thank you. And for the record, I wasn't suggesting that we do that.
The gentleman from California. Thank you.
Thank you, Mr. Chairman. I want to thank the chair and ranking member for convening this panel and for the panelists being here. It's my hope that our committee can use hearings like this to engage in a serious discussion about the housing market. We have seen too many debates on serious issues hijacked by the special interests in the special interests agendas. For example, in this committee, a budget was reported to claim to tackle the deficit and debt, but really represents an agenda to privatize Medicare and block grant Medicaid in order to pay for more spending tax on charity for the top 2% of our earners. This is unacceptable. We are facing serious economic issues in this country that Congress must address. The eyes of the nation and indeed of the world are upon us. Today we have two critical questions to address. First, Republicans have a single mantra regardless of the issue: deregulate, deregulate, deregulate. The market will police itself. Will completely deregulating the housing market prevent a future crisis? I think everyone, Democrats, Republicans, understands that certainty is a key ingredient for a high-growth economy. So my colleagues across the table would like to wind down Fannie Mae and Freddie Mac. However, given the increasing income inequality in our country, and I'll say that again, given the increasing income inequality in our country, when the median income for 90% of families is around $30,000, given these factors, under the Republican proposal, how will the bottom 90% buy homes in the absence of Fannie Mae and Freddie Mac? And will they be able to obtain a 30-year mortgage at reasonable rates? I may like to start with Ms. Lucas, and then Mr. Pollock, and then end with Wartell.
Okay.
You have a minute each.
Okay, well, CBO really hasn't done an analysis of what the effect would be of reducing the subsidies to Fannie Mae and Freddie Mac. It is clear that if they were less subsidized, the costs of borrowing would go up to some extent. There's been some estimates that range from just a few basis points to over 1%. Whether that's a good or a bad thing, I think depends on the perspectives, and I'm going to let my colleagues on the panel give those perspectives.
Congressman, in my judgment, these median income families will be able to buy houses and with mortgages in a market system with market prices. You mentioned regulation. I'd like to point out that one of the reasons why house prices are falling right now and why the housing market is so soggy is the natural regulatory overreaction in the wake of the bust, which has had the effect of making mortgage credit much more difficult to get because the lenders are terrified with the increased legal and regulatory risks of even making a loan. So we can all, I'm sure we've all heard endless anecdotes about people with good credit who are put through the most outrageous process even to get a loan. And when the credit is tied up in this way, it makes it harder for anybody to buy a house. Just as an example, and again, this is a normal, we see this cycle after cycle, that in the wake of the bust comes a regulatory overreaction of clamping down excessively, which makes recovery from the bust more difficult. A second reason that I'd like to point out why we have continuing serious problems is exactly the 30-year fixed-rate mortgage. The 30-year fixed-rate mortgage is an instrument which, if housing prices are inflating, works very well. If housing prices are deflating, it's a terrible instrument. It locks people into high mortgage payments, which they can't get out of, and when they don't have the equity to refinance, they're trapped in the mortgage, so we have endless programs of trying to modify and change the rates on the mortgages to reflect the current market, which don't work very well.
Thank you.
So we do need to understand these underlying causes of our current problems. Thank you, Congressman.
Thank you, Mr. Chair. I'd like to have Ms. Wartell.
For the median income family that you describe, the availability of long-term finance allows them to set their housing prices. If they were subject to only affordable adjustable rate mortgages, they would recognize that if their housing as interest rates fluctuate, their housing costs could suddenly grow dramatically. Families, the transaction cost for a family to move their home because their housing just got more expensive is far more difficult than it is for investors to adjust their portfolios in different interest rate environments. So it's the availability of the long-term finance that I think is so important to the median income family. Under Mr. Campbell's bill and my own proposal, the cost of the subsidy that the GSEs got will be priced in the future, which means housing costs will go up a little bit. And everybody thinks that's appropriate. We shouldn't have a hidden cost to the taxpayers. But what is important is the consistent availability of credit to allow people to make investments in homes.
Thank you.
Gentleman's yields back. Gentleman from Indiana.
Yes.
Thank you, Mr. Chairman. Appreciate the witnesses coming today. I've enjoyed listening and have one, maybe two questions if I can get them in. First to Mr. Pollock. Earlier this year, Dr. Carmen Reithart, you may be familiar with her work, testified in front of this committee. She has done extensive work on debt burdens, specifically in countries or models that have 90% debt to GDP ratios, and what the negative impact on economic growth is. One thing she talked about was that not only does public borrowing rise precipitously ahead of a sovereign debt crisis, but that the governments involved when this happens are often found to have quote-unquote hidden debts. Mr. Pollock, from your testimony, you would say that the U.S. has hidden debts, right?
That's correct, Congressman.
Okay. What is the impact of GSE and other agency debt, so not just GSE, on our fiscal solvency? All right, I'm getting a little away from Fannie and Freddie here. As our debt held by the public approaches the high levels that Reinhardt discusses in her analyses?
I should say that Carmen and her husband are good friends of mine, and we share many approaches to understanding financial cycles. When any borrower is running up his debt, it's very tempting to try to put the debt in an off-balance sheet way that is observed again and again in private markets, and it's also observed in government markets exactly as you suggest. So the curious thing about the explosion of agency debt over the last 4 decades is precisely this creation of a debt. Really wasn't hidden. I mean, we knew it was there, but it was hidden in terms of the official way we talk about the debt. The result, among the results, being much more risk to the taxpayers, a higher cost of financing the Treasury, and I reiterate my recommendation that we ought to require the Treasury to provide an annual report to the Congress on the extent to which agency debt has made Treasury debt more expensive or has affected Treasury debt, and on the overall creditworthiness of the government, and I reiterate my recommendation that we ought in statute explicitly to make the Treasury responsible for managing the overall creditworthiness of the United States, and that means they have to manage the debt of these mixed ownership government corporations like Fannie Mae and Freddie Mac are. We just have to recognize the reality.
Thank you, Mr. Pollock. And I said this was a question to Mr. Pollock, but I was wondering now if CBO wants to comment on the same set of questions.
CBO has published various reports that talk about different measures of the debt, and certainly the public debt is the public debt, but these other obligations affect the fiscal situation of the United States. I think it's important to think about the sum of the two, as Dr. Pollock has. I think it's also important, though, to recognize that not all debt is the same. So the debt of the GSEs is backed by the mortgages that are making payments on that debt. So it's not quite the same thing as debt, which is just backed by tax revenues from the citizens. So it certainly matters,
Debbie,
but
you're
I think
right.
it has to be a little bit careful.
Just like the civs of Citibank.
Say that again, please.
Just like, this term CIV, Congressman, SIV stands for Structured Investment Vehicle.
Thank you.
Just like the civs of Citibank, I said.
Right,
I was
thank you.
having some fun with my good friend and colleague.
Do you have a serious comment? I was going to ask you if you had a reply to that. A serious one.
Well, no, I agree. We have to look at the whole picture, just as any entity looking at its finances has liabilities of different kinds, but you have to tote up the total liabilities and figure out and control their effect on your creditworthiness.
Okay. Thank you very much, Mr. Pollock. And then, Ms. Wartell, not to leave you out, and if you want to quickly comment on that, you can, but I'm very interested in this rent versus buying. The president, or at least the administration said
Would the
that.
gentleman yield on?
Sure.
Ms. Lucas, you said it's all the debt is backed by mortgages?
Well, I was just noting that the debt that the GSEs has issued was issued in order to purchase mortgages.
But
So
but not their entire book of all their debt is backed by mortgages, correct?
At the time when they issued the debt, they're issuing it to purchase a mortgage. Some of the mortgages have since fallen in value, and so there's a gap between the value of those mortgage assets and the liabilities of their debt. And that gap is what's reflected in those costs of the business that they already have. I didn't mean to say those were not real costs, only that when you have an asset as well as a liability, the existence of the asset can change your view of the liability and what it does to the stability of the financial situation of the country.
Thank you. Yield back.
Thank you, Mr. Chairman. Just real quickly, Ms. Wartell, I'm intrigued by the concept that we're starting to realize now that maybe not everyone should be or has to be a homeowner in order to realize an American dream. Maybe the American dream evolves and changes. Do you think the history of pushing people to buy homes has distorted markets and that perhaps not everyone should own a home?
I think there is widespread consensus that federal housing policy has been imbalanced, that we need to get the balance right, that we need to make sure that there are appropriate housing choices for everyone at their stage of life and with their family conditions. That means we need to ensure there is credit available to finance rental housing and that there are good rental housing choices.
Thank you.
Absolutely.
Okay, thank you, ma'am.
And I thank you. And the lady is recognized as soon as the light comes on. There you go.
Thank you, Mr. Chairman. I want to thank our witnesses very much and our committee for at least providing us the opportunity to talk with one another across party lines. My two main questions are, and I'm going to make a statement after the question so you can think about the questions. 6 banks in our nation now control 2/3 of our banking system. How do we restore real competition for mortgage credit? And number 2, how do we restore prudent mortgage lending and origination that recapitalizes local and regional community financial institutions, not distant speculative lenders? Some, as you've heard this morning, want to blame Fannie Mae and Freddie Mac for the financial meltdown. I'd like to put their role in perspective as I see it. They were doing fine until deregulation of private financial markets occurred during the 1990s. And what we've experienced now in this past decade is the government has become the dumpster for the mistakes of the private sector, and the costs are enormous. High-risk behavior in America's housing market began during the early 1990s when financial deregulation, pushed by some here in Congress, allowed the private financial sector to turn formerly prudent mortgage loans into bonds and then securitize them into the international market in a manner that bore no relationship to true value nor the local real estate market. I would like to place in the record an article from this week's New York Times, The Good Banker by Joe Nocera. There are many good bankers left out there. They need to come before our committee and help us figure out a better future for this country. I remember in the early 1990s when the largest commercial banks and later Wall Street speculative investment houses came up here and applauded the demise of the staid thrift industry and its conservative mortgage lending practices as the big Wall Street banks hungrily sought after a globalized market and after the housing market that they had not been into as a new national profit center. I recall when the sign outside the door of the former Banking and Housing and Urban Affairs Committee was taken down and that committee renamed the Financial Services Committee. That signaled a new era of abandonment of strict practices in mortgage loan origination and standards of prudent lending that had regulated private sector mortgage behavior for most of the 20th century following the Great Depression. In fact, during the 1990s, the securities jurisdiction of the Energy and Commerce Committee was merged under that Financial Services Committee as Congress passed, without my support, the Leach-Bliley Act. And when the Glass-Steagall Act, that had separated banking and speculation since 1933, was wiped off the books in 1998 under that Leach-Bliley Act, the speculators were unleashed full bore. I have a bill, H.R. 1489, that would restore important Glass-Steagall provisions. Fannie Mae and Freddie Mac were not the quarterbacks in this game of market manipulation. Wall Street was. But Fannie and Freddie were very important wide receivers in this high-stakes, big bank hyperventilation of the mortgage market. The private sector big banks and speculative houses soon discovered that home mortgages were pretty sleepy instruments with a 30-year payback time horizon that didn't yield the quick 7-year payback of commercial loans or speculative prospects. So the big banks and their minions in the origination, servicing, and rating industries figured out how to inflate their returns. I'd like to place on the record a few pages from the book published in 1996 by former chairman and CEO of Fannie Mae, James Johnson, entitled Showing America a New Way Home. In it, he clearly describes what the private sector was up to, transforming the way America financed home buying, the mortgage system, from an industry that is almost exclusively dependent on depositors to one that is investor-based. He lauds the fact that capital to finance home ownership will be virtually unlimited, I'm quoting, unlike the former savings and loans, and that international capital markets will now assume the risk and are superbly well equipped to evaluate performance as they invest in securities backed by mortgages. Fannie Mae and Freddie Mac were wide receivers in this transformation, but the quarterback sat on Wall Street and on the board of the Federal Reserve. Looking back, it is hard to understand how he could have such unguarded faith in an untested system of the deregulated global private financial marketplace for housing finance. But that is what happened. And Fannie Mae and Freddie Mac then adopted high-risk practices too, becoming key agents to move this mortgage paper into international tranches. For our nation to dig itself out of the worst housing depression since the Great Depression, we must go back and unwind what happened and restore prudent lending standards again. I have a bill, the Fannie Mae and Freddie Mac Investigative Commission Act. It is a straightforward piece of legislation that creates an independent commission to investigate and analyze what policies, practices, and board decisions on risk management that were made at Fannie Mae and Freddie Mac that led to the enterprise's financial instability and the subsequent conservatorship of the two entities. This commission would build on the work of the Financial Crisis Inquiry Commission as a basis for, again, disciplining the financial practices that led our nation to such a precipice. I have many, many documents to enter into the record, and Mr. Chairman, I will wait till the second round for them to address the two questions I've asked about competition in our restoring competition in our banking system, again, and recapitalizing local markets that are capital starved at this moment.
And the gentlelady yields back, and as the gentlelady indicate, as long as our panel is available, we are going to do at the request of some of the members, a second round. And we should probably put the caveat that to the members that are here too, since these members have been sitting here through all this. I will yield at first to the gentleman from California.
Thank you, Mr. Chairman, and it's Mr. Pollock, we have to have a little discussion about some of the things that obviously that you and I disagree about. In your comments and responses to the gentleman from Indiana, I believe I heard you advocate for lower housing prices, correct?
Congressman, first of all, let me say I really look forward to a discussion when we get a chance in person to go over some of these things. I know you're very knowledgeable on these topics, and I would look forward to that a lot. Lower housing prices are obviously good for some people, namely the people who are buying houses, especially the first-time home buyers. They're bad for people who bought the house previously at a higher price. They're like the price of anything. When it goes up, it's good for the people who are long, and when it goes down, it's good for the people who are short.
Yes, but I believe I heard you say that you thought they were too high and that they were artificially propped up and that this was hurting new home buyers and that we ought to let them fall.
What I was trying to point out was that in the housing bubble, we, without question, artificially inflated house prices
Okay, how
to
about
a
now?
great
How about now?
extent. And I think they're probably now, in my own forecast, they're coming across a long and rocky bottom where house prices will be falling in real terms, but moving in a irregular flat line in nominal terms.
Okay, that's what you forecast, but you think it would be good if they dropped some more?
The specific point I make is that the gentleman asked about what is an obstacle to home ownership for first-time home buyers, and I said high house prices, inflated house prices are such an obstacle. There are other obstacles, of course.
You know, we have to switch places because you're very good at not answering the question. That's supposed to be our job. But I heard what you said and before to the gentleman from Indiana, and now I think maybe I get it. Because if you believe that a fall in home prices is okay, then having no government support for the system, which will trigger that, and that's okay. But the recession, near depression that we had in 2008 was triggered by a 28% drop in home prices. I don't want to do that again. I don't want to see that again. And home prices are already, the home market, it's 1/7 of the U.S. economy, and it is already holding back this recovery, and we're not going to get any kind of recovery if we don't have a robust housing market. And removing that support and triggering another significant drop is just going to move us into recession, which in terms of the budget committee that we're talking about here means less revenue, and it means that all these Fannie and Freddie debts, which none of us are happy about, but we got them. I mean, the taxpayer has them. And further declines in home prices, I think there is no dispute about that, is going to cost taxpayers a lot more lost money on Fannie and Freddie portfolios that we already have. You'd like to comment on that?
Yes, I'd love to, Congress. Thank you very much. First of all, the trigger, of course, for the fall in house prices was the 90% inflation in house prices, which made the subsequent fall absolutely inevitable. The fall was about 30% of the peak, which is about 60% of the,
okay,
of the base.
Mr. Pollock, you always want to go back and talk about that. I'm wanting to talk about where we are now and where we might go now.
Well,
and if I'm wrong on this, say I'm wrong, but your concept of what you want to do going forward will result in a drop in housing prices, and you're okay with that. Is that correct?
I think that is not correct.
Okay, explain why.
My view is that getting into I think it would be correct if our proposal were to happen in 5 minutes, but since it's a 5-year transition, I think it's not correct.
What does the 5-year transition make it not correct? If
the very point of a 5-year transition is to leave the financing, which is now in place with the support of the government and the taxpayers, to get us through the transition out of the bust, which is unfortunately necessary because of the bubble.
Okay, well, Mr. Pa, just in my final 22 seconds, my conversations with the people who would lend the money, I know you seem to think that there will be 30-year fixed-rate mortgages without government support, but we don't have to speculate. That exists. There's the non-conforming market, the jumbo market out there right now. And as Ms. Wartell indicated, you can get a jumbo loan at a 30-rate fixed with like 50% down. And if that's the place we're going, and that's what it looks like, and that's where your proposals would lead us, that is going to make the last housing drop look small. And that's why we can't afford to have that happen. I yield back. Thank you, Mr. Chairman.
Ms. Kaptur.
Thank you, Mr. Chairman. Going back to and I'm very interested in your comments on my statement. That's how I view the world. 2 questions. 6 banks in our country now control 2/3 of the system. What do we do to restore real competition for mortgage credit, just taking that piece of the credit system? And secondly, how do we restore prudent mortgage lending and origination that recapitalizes local and regional community financial institutions, not distant speculative lenders? Anyone that wants to? Yes, Ms. Wartell.
If I may, thank you, Ms. Kaptur. I think that having a system of housing finance in the future that ensures access to the secondary market for community-based financial institutions is one of the goals of the kind of proposal that CAP has and could well be achieved under Representative Campbell and Peters' legislation with some minor adjustments. It is a great concern to me that we have such concentration in a very small number of lenders for origination of so much of our mortgage market these days.
The gentlelady yield just for one statement, and also a group of individuals and institutions that have no respect for the local real estate market. When they end up owning these homes and holding these homes, they don't take care of them. Plumbing is ripped out. What's going on across this country is a disaster.
In a fully privatized world where access to the secondary market will depend on where lenders' ability to sell, the larger financial institutions will have a far greater ability to access the secondary market. As many of them developed their own private label security origination schemes during the last bubble. My concern is that there be a mechanism to ensure that small banks and community-based institutions like CDFIs and others have access to the secondary market. Our proposal includes a requirement that those who insure mortgages and package them for securitization should not be originators of those mortgages, except to the extent that it's in the form of a co-op of originators, so that we can ensure that a wide array of financial institutions have that access. That will, I think, in part address some of your concerns that community-based lenders can't effectively
May I
compete
ask
against these large
you assume
institutions.
securitization is fundamental to the housing system of the future?
Yes, I do. I think we need to, if you were to take the size of the housing market today and imagine putting that on balance sheet of our current financial institutions, it would dwarf their capacity to lend, and it would collapse access to capital for other parts of our
But
economy.
how do we strengthen local institutions as opposed to these very irresponsible, distant institutions in that scheme? I'm not sure I support securitization as the only option for the future.
I don't support it as the only option. I think we need to go back to a world in which we have securitization and balance sheet lending, as we did in the past. Some of that securitization needs to be like FHA lending for targeted borrowers, and some can be private with private capital risk, but access to the secondary market through liquidity backstop, and some of it needs to be fully private. But what we need to do is have appropriate regulation to ensure that lenders throughout our economy, large and small, can access those markets.
Thank you, Mr. Pollock. You've been waiting to say something.
Congressman, I have to say, I enjoyed your comment so much because it makes me think of one of the great proofs that economics is not a science, and that is that whatever happens, we can have mutually inconsistent interpretations of the events, and neither side can prove its story. And by the way, Congressman Campbell, I really look forward to some further discussions. I know we'll find something we agree on.
And I do too. I failed to mention that, but I look forward to further discussions as well.
I have in the course of my career worked for big banks,
I noticed.
and I ran a thrift.
I
So I have some experience with that.
You're on the Federal Home Loan Bank Board.
And a federal home loan bank. The thrifts, of course, were extremely heavily regulated and nonetheless collapsed. When I was with the Federal Home Loan Bank of Chicago, we made the observation that you could find a regularity in the mortgage market, and that was that the mortgages originated by small banks and thrifts had consistently higher credit quality than those originated by all other originators. And we set out to give them a better way to finance these mortgages, because we used to say to them, what do you think the credit quality of your mortgages is? And they would say, excellent. We'd say, what do you think you charge off a year on your customers, your local mortgages? And they'd say 1 basis point a year or something. So we said, well, in that case, why did you want to pay 25 basis points to Fannie Mae and Freddie Mac to divest the credit of your own customer? That doesn't make sense. And they would say, I never thought about it, but you're right. They were basically being overcharged for the transfer of the credit risk consistently for decades by Fannie and Freddie. So what I would like to see is a way for small banks to be more robust competitors in the credit sector of the market, where they're demonstrably extremely competent actors, where they could retain the credit risk, be paid for retaining the credit risk, but have a way to finance the interest rate risk. We actually have designed a program like that, which I think much more could be made of if we set about it rightly, because we have a set of actors in our 6,000 or 7,000 smaller banks that make mortgage loans, and whose local credit talent we need to take much more advantage of.
I am so glad you came today. We probably don't agree on many other, many things, but I want to thank the chairman, because I think this is very valuable. Members of Congress don't talk about this very much, the whole housing sector and its terrible role in bringing our economy down after the rise in gas prices triggered the whole mess, and the rise in oil per barrel back in 2008. But it's really sad that this institution has not met its obligation to the American people. When you look at what's happened over the last 3 or 4 years and the hemorrhage that's going on across this country. So I would just encourage the chairman to bring them back with let's bring a brown bag lunch, and let's talk about their experience, because somehow these discussions are not occurring in the Senate. They're not happening in the Financial Services Committee. Maybe this Budget Committee could do the country a favor. We need to take the best talent we have, take the bills that are being proposed and actually try to do something on a bipartisan basis to move forward. I'm very concerned about the future and about our credit system, certainly for mortgages, and about the hemorrhage in this housing market that is devaluing these assets and destroying these assets as we sit here today. So I would just ask the chairman to think forward, and, you know, I'd be willing to work with you and our chairman, Mr. Van Hollen, in that effort.
And I thank you, and I know you've been very interested in a leader on this issue, and just one differ is that, yes, we have actually been taking up these issues in financial services, at least in the Capital Markets Committee, as some of these members have been here on that, but I look forward to the idea of coming again and exploring them. Gentleman from Indiana.
Thank you, Mr. Chairman. Just picking up a little bit on the question I asked Ms. Wartell about the American dream and the idea that, and this came out in the exchange you had with Representative Campbell, Mr. Pollock, the idea that our economy, I know, I'm not going to let you leave it, somehow it revolves or orbits around the idea of housing starts and home ownership, and we can discuss the definition of the American dream and if it should stay the same or if it should evolve, or if politicians of both parties have forced the American dream by distorting the free market system instead of allowing Americans to earn the American dream. But can each of you point to any economic and empirical data, right, not cultural or political rhetoric, about, again, economic or empirical evidence of why the economy should be based on home ownership or home starts or home building or anything like that? I receive a good deal of support from the Home Builders Association, so I'm sure I'm going to be in trouble for this, but we have to be honest, as Ms. Capter says, and if we're going to ask these questions, figure out, you know, why it is that it has to be this way, that the economy has to center itself around home building. Ms. Lucas? And home ownership.
Okay. Well, from an economist's perspective, it doesn't have to be centered around it. It is an important part of the economy.
Why?
Because people want and need good places to live. So I'm a little perplexed by the question. That is, there needs to be homes.
I'm talking about home ownership.
There needs to be homes. No, certainly there can be, there's a role for rental housing and there's a role for home ownership, and there's other countries where rental housing plays a significantly larger role and people seem to get good housing services through the rental markets there. So it's true that our economy has sort of moved in the direction of heavily favoring home ownership, and we could be organized in a different way, but where we are right now is that is a large fraction.
Okay, thank you. Same question.
Congressman, if you look around the world, home ownership rates vary a lot among countries. Among developed countries, the U.S. is sort of in the middle of the pack in terms of the percent of households who are homeowners, who are neither the highest nor the lowest. An interesting country is Switzerland, a very rich, pleasant country, which has very low home ownership, perhaps consistent with your hypothesis here. It also has a central bank whose shares are publicly traded and where the citizens can buy shares in the central bank, an interesting concept, by the way. My view would be that obviously shelter is a very big and very important sector, and that people ought to exercise their preferences to own or rent as they like and as they are able. And many people will like to own and will be able to own. Others will like to rent. And that should be a market outcome left to the voluntary exchange of the citizens.
I note your term voluntary.
I largely agree with Alec, and since that doesn't happen, it's worth that often, it's worth noting. But I would note that in our society, we have created a system that uses housing as a principal form of savings for American families. And people essentially pay down their mortgages over time, and they receive significant tax advantages for doing so. So we are, in a sense, encouraging that savings and that wealth. accumulation, and that wealth accumulation allows families to both invest in small businesses and the educations of their children, as well as provide for their own secure retirement when they're no longer earning. We could make a policy decision not to encourage savings in that form and to do that differently, but those are very fundamental changes in the way our tax code operates and our housing system has been built. Unfortunately, we've created that set of incentives, but we've only allowed some to participate in it. And so we have enormous disparities in wealth in our society, especially on racial grounds, but on a wide array of grounds, including geography. And so that some people are getting the benefits of those subsidies and that encouragement for homeownership and others are not. Unless and until we're prepared to say that we don't want to encourage homeownership, then it seems to me important that we ensure access to homeownership as a means of accumulating wealth and to give access to the opportunities to grow businesses, to educate children, and to have a secure retirement.
Thank you, Mr. Chairman. Very educational. I yield back. Thank you, witnesses.
Gentleman yields back. Gentlelady from Florida.
Thank you, Mr. Chairman. My question is for Ms. Wartell. Would you agree that one way the federal government can assist in stabilizing the housing market is by helping to prevent avoidable foreclosures?
Absolutely.
Okay. So, I'm from the state of Florida, and, right now we have many homeowners who are locked into high interest rate loans, and they don't have the ability to refinance. They've lost too much equity. Many of them are upside down. 4.5 million borrowers with outstanding mortgage loans in Florida are in that situation. 2.1 million owe more than the value of their home. That's 47% of the population in Florida. Nearly 20% of underwater mortgages in the United States involve Florida properties. So allowing homeowners to refinance and lock in historically low rates would help a lot of people be able to stay in their homes. Our colleague, Dennis Cardoza from California, has introduced legislation. I don't know if, Mr. Chairman, that's been spoken about already, but he's introduced legislation called the HOME Act, the Housing Opportunity and Mortgage Equity Act, and that would require Fannie Mae and Freddie Mac to allow homeowners to refinance those mortgages. So rather than pull the rug out from under the housing market, isn't there a better solution like this one for stabilizing home prices?
I think finding ways to avoid avoidable foreclosures is got to be an enormous priority in efforts to stabilize the market. I'm not familiar with that legislation, so I'd rather not comment on it now without looking. But I would say that there are a couple of different strategies that are useful in that. One thing we've written about in the past is mediation, which requires lenders before they foreclose to sit down with the borrowers and consider seriously with an advocate on their side before they foreclose. Nothing forces them to do a modification, but gives them another bite at the apple. There have been models in a number of states that have been very successful in showing that lenders actually get higher recoveries through those programs. I think taking a look at what's happened to credit scores because of the foreclosure crisis to help people become eligible for refinances, of the kind you've mentioned, is another piece, and I think I've been encouraging the administration and others to bring together the credit rating agencies and the lenders to work on that. I think in the servicing standards, the lenders we have to establish national servicing standards, and lenders have to be encouraged to give loan loss mitigation a more serious try before they move to foreclosure, and essentially they become worried about time. And I think that there are tricky issues with Fannie and Freddie in mandating them to refinance, because it is not always the case that a refinance in that case will result in higher recoveries. And the government in the current period has an obligation to mitigate their losses. But I think it is possible to, if you do that in the right circumstances, to encourage Fannie and Freddie to do refinancings or principal write-downs. It might actually increase recoveries.
And you would agree that it's certainly better than what the Republicans have proposed, which is to just get rid of all the foreclosure mitigation programs and do nothing else and leave people twisting in the wind.
I understand the frustration because many of these programs have not worked and as nearly as well as we would have liked, and I think we don't understand something about the behavioral models of the financial institutions as to why what seems to be economically rational hasn't been steps that they've chosen to take. But I think that approach, which is to throw the baby out with the bathwater, if you will, is only to doom us to sort of finding the bottom faster in very painful ways.
But what disturbs me is that the only thing that our Republican colleagues under their leadership has proposed is what our colleague, Mr. Henserling, has said, and that is that the best foreclosure mitigation program is a job. And that's certainly a let-them-eat-cake approach, and one that isn't going to help solve the problem over the long term. Would you agree?
I would. I think that avoiding avoidable foreclosures is not only in the best interests of maintaining the larger economy, it's also in the lender's best interest, and we have to find a way to see where those interests align.
Thank you very much. I yield back.
The gentlelady yields back. Yield the gentlelady for introduction.
I thank the gentleman. I just wanted to encourage the chairman and the ranking member to keep focus on deep probes about the future of the U.S. housing finance system is essential to our system of capital formation. And I just wanted to put on the record the book, The Mystery of Capital by Hernan de Soto, where he talks about the importance of our property valuation system, and housing is so tied to that now, as essential to our form of capital accumulation and savings in this country. We need to be talking at that level in this Congress about where we're headed with this market. And so I thank the chairman for this hearing today and look forward to working with him and Mr. Van Hollen in the future to do a better job for the American people.
And I thank the lady for that. And I will yield myself the remaining 5 minutes of this hearing to just run down a couple questions. So we heard from, at the very outset, from Ms. Lucas with regard to the necessity or the encouragement for to go to consistency and a more transparent and a fair value rating or according to as far as accounting. We heard from Ms. Wartell to say that as far as what's on the books now, we should not, for all the debts that's already incurred, we should not go back and change it for what's on the books already and use that system, correct? And basically going forward, though, I also thought I heard you say that you would not suggest that we go and adopt what the CBO is recommending with regard to changing the evaluation or the accounting methodology for the entities. Is that correct?
As to the GSEs, I think in their current form in conservatorship, that's correct.
And with the FHA?
With the FHA, I believe that they should be accounted for under credit reform. They need to improve their models, which I think they're working on. But I think the fair value accounting is should certainly not be done only for FHA, and I think probably needs to be refined significantly before it were adopted government-wide.
Would not, but my understanding, though, is you would not then take into the risk factor that is which CBO would be placing in their accounting. Is that correct?
This method of pricing that risk factor is not one that I think is appropriate at this time.
Right. And that's where we disagree, because I think most people would understand that you have various risk factors both in the pricing of housing going forward over the next 30 years. You're nodding your head that that's a risk. And also there's certainly interest rate risk, and the first, of course, is credit risk. Somehow or other that has to be taken accounted for. The system we have right now, correct me if not, shows actually that there is a profit over at FHA, correct?
For FHA.
Correct. And I think the gentleman from Indiana made somewhat of a flippant sort of comment saying, well, if that's making a profit, then I guess we should insure the entire marketplace. Is there any reason why his flippant comment is not correct, that we should not insure the entire market if we're making a profit there or expand it significantly?
Yes, and I think the reason is because of the wisdom of the policymakers in this committee and in this Congress, who won't, simply because it's a revenue source, make decisions that are bad for the housing market.
Okay. At the very beginning of our hearing today, Mr. Van Hollen started off by saying, well, no one wants to go back to a system that guarantees either explicitly or implicitly, and then he continued on. But after the last hour, I realized, yes, there are. The gentleman to the right wants to do that, and the gentleman over to the left also wants to do that. They do want to go back to a system that has, at least at some level in their proposals, at least at some level where the government will explicitly guarantee it. And so my question is to the panel, is it possible for us to devise a system? Well, maybe, Mr. Pollock, you said something that really sparked an idea in my head. You said we've already tried that to the extent to say that with the GSEs, to say that, well, there was private equity in there and it got wiped out. Isn't that really just on a different variation of what these various proposals are here today, that will wipe these things all out, but you still, at the end of the day, the federal government, that means you and everybody in this room, backs it up?
Yes, I agree with that, Mr. Chairman.
Okay. So there is any version that comes out, either side of the aisle, as well-intentioned as they mean, where at the end of the day that the federal government has to step in to provide the liquidity into the marketplace, means that there is a guarantee by the federal government. Ms. Lucas, is that too simplest of an understanding of that there's a guarantee at the end of the day?
No, I think it's absolutely right. And I think the challenge in the design of moving to a new system is to make the need for that as unlikely as possible.
The need, and was that not also partly the design for the GSEs that we have right now? The design was to make it unlikely and not possible because you had so much, that was the system we already just went through, correct?
That's right.
All right.
It was a system where they tried to put private capital there, but the requirements for the capital were quite thin.
Right. And another point, the gentleman from South Carolina made an interesting point with regard to what this is costing us. And he came up with a number of $140 billion a year in the sense that there's a cost to the fact that we have so much GSE debt out there, right? Agency debt out there. This is impacting upon the price of treasuries. Mr. Pollock, you said that, correct?
That's right, Mr.
Does
Chairman.
anyone disagree with that assessment, that the fact that we have so much agency debt out there, that affects in some way, shape, or form the price of treasuries? No one
I haven't had a chance to look at the study Alex refers to, so I'm happy to comment for the
If
record.
that's true, though, and the gentleman says that that's costing even $100 billion, shouldn't that be reflected somewhere in our accounting for the federal government? Besides the price risking that Ms. Lucas is talking about, shouldn't that be reflected someplace in our budget?
If that is the case, it is, because that's the price the Treasury is paying for the debt. So I think it is reflected in our budget.
So it's priced in the fact that it's costing us more money to borrow all the money that we're stuck having to borrow all the time, is what you're saying.
But we don't understand it as an effect of what we're doing with agency debt.
But it's just, you said it's built into the higher cost of borrowing, is what Ms.
I'm not prepared at this point to comment on the study because I haven't seen it. But Treasury pays the price the Treasury pays for a debt, fluctuates based on a variety of factors consistently. And to what extent the size of the agency debt is a part of that, I can't comment today.
And last point on this, not to open up the whole thing, but the gentlelady from California made the accusations that we don't care as a Republican side of the aisle and that sort of thing about people twisting in the wind and that what. And I don't think anyone on our side wants that to occur.
Of course.
But isn't it possible that we can try to get to the same end game, to try to make sure that there is sufficient housing in the country, to try to deal with the situation that the gentlelady is trying to deal with here, people in difficult situations, that instead of financing debt, which is what our system does right now, correct, we could finance equity. And we could finance equity through a whole host of other programs and it still get to the same end game of trying to deal with the housing situation. Isn't that an alternative to this situation?
I'm not sure what you mean by financing equity. If you mean provide direct grants in the form of
various programs,
down payment assistance, you can, although the leverage there means that the additional amount of assistance is significantly more expensive for the taxpayers.
And it's all on the books as well.
That I would argue that the goal of credit reform and all of our policies here is to put it on the books. And if I might just, sir, the one difference between the past and any of the proposals in the future is that the guarantee for the GSEs in the past was implicit, not explicit, and they never paid for it. And what we are all proposing for any system in the future is that it be paid for so that that would be on the books.
And I think we'll close to understand that someone's going to pay for it no matter what. You're right. But I do thank you very much to the panel. And the gentlelady's comment with regard to further hearings on this or other discussions, formal or otherwise, I think would be a great thing because they are so technical and it is so very important. So thank you for that. We'll look forward to doing that. Thanks to the panel again. And I guess the record, it will be open for the next 30 days. And if there are additional questions, they can submit to the panel. And to that end, I'll take the prerogative of the chair and to submit one question to Ms. Wartell right now to elicit your comments or on that last question with regard to the studies. That'd be fantastic. Thank you again to the panel and all to the members who stayed with us. Thanks. The meeting is adjourned.